walk me through this. You see historically rich valuations in other asset classes, not within U.S. equities?
Yeah, so Taylor, this is a great question, and number one, it's great to talk to you today. I think this is a really challenging puzzle for investors. On the one hand, long-term equity investors look at a lot of traditional valuation metrics and get uncomfortable by the numbers. They might say, at north of 20 times forward earnings, even if we can actually predict the earnings, that's a separate conversation. This is a market that feels like it's fully valued. At the same time, one of our core beliefs is that you really need to look at equities relative to the rest of the opportunity set. And as I mentioned in that note, whether it's in credit or in rates or basically any other asset class, we are at the top end of historic ranges for valuations. The thing that really drives the equity market, though, Taylor, is the growth of the biggest leaders in the market. Even in this pandemic environment where the economic backdrop is weak and I would argue uncertain. I know some folks feel like we're in a massive recovery. I'm not quite sure I'm there. These companies are actually continuing to generate revenue growth, and we're seeing a significant change in terms of behavior and consumption patterns that are leading these companies to continue to produce profits even in this challenging environment. And so they deserve a higher multiple. But I do understand why people get uncomfortable with valuations at this point.